Imagine watching two traders with identical strategies, identical market knowledge, and identical charts. One makes consistent profits year after year. The other loses money and eventually quits. What's the difference? It's not their system. It's not their analysis. It's something far more powerful and far more hidden. The successful trader has cracked a psychological code that 95% of traders never even realize exists. They've discovered that the real battle in trading isn't against the market, it's against their own mind. And once you understand this battle, everything changes. Most traders spend years perfecting their technical analysis, studying fundamentals, searching for the perfect indicator. But they're fighting the wrong war. The real enemy isn't market volatility or economic news. It's fear, it's greed. It's the voice in your head that makes you doubt your strategy right when you need it most. What I'm about to share with you isn't just another trading strategy. It's the psychological framework that separates winners from losers in the most unforgiving arena in the world, the financial markets. These insights come from Trading in the Zone by Mark Douglas, a book that has transformed more trading careers than perhaps any other. Mark Douglas was one of the first to clearly explain how the real edge in trading doesn't come from your strategy or indicators, but from your mindset. This book helps traders break free from emotional decision-making and start thinking in terms of probabilities, consistency, and confidence. In the first chapter, we explore the road to success and discover whether fundamental, technical, or mental analysis is the key to trading success. Most traders start with fundamental analysis. It feels logical. Study the company, look at earnings, understand supply and demand, global news, and economic indicators. The belief is simple. If you know enough about the fundamentals, you can predict where the market is headed. It's appealing because it offers a sense of control, almost like solving a puzzle. But Douglas points out that for many, this approach leads to frustration. Even with solid research, the market doesn't always move as expected. Prices often behave irrationally, and traders get caught off guard. That's when many shift to technical analysis. Technical analysis feels like a breakthrough. Instead of focusing on why something is happening, it focuses on what is happening. Price patterns, indicators, support, resistance. It's all about recognizing repetitive behavior in the market. For a while, this gives results. You feel like you're finally in sync with the market. But then, problems surface. Even the best setups fail sometimes. Trades that look identical have completely different outcomes. Confidence starts to shake. The trader wonders, if I'm doing everything right, why am I still losing? That's where Douglas brings in the real turning point, mental analysis. He argues that the true key to consistent trading success lies not in the market, but in the mind of the trader. It's not what you know about fundamentals or how well you read charts. It's how you think, how you feel, and how you behave under pressure. The market is unpredictable. It moves in probabilities, not certainties. But most traders operate with the need to be right. That need triggers fear, hesitation, impulsiveness, or revenge trading. Emotions take over and the method gets lost. Douglas makes it clear, success in trading isn't just about having the right strategy. It's about having the right mindset. Consistent winners think in probabilities, accept the randomness of outcomes, and manage their mental and emotional responses. They don't try to control the market. They focus on controlling themselves. This shift from external analysis to internal awareness separates amateurs from professionals. It allows a trader to stay calm in chaos, stick to their plan, and execute with confidence. In the second chapter, Douglas reveals the lure and dangers of trading. Trading holds a powerful allure. It represents freedom, work from anywhere, be your own boss, no limits on earnings. The potential rewards seem endless, the perfect opportunity to escape traditional job constraints. Douglas explains this freedom makes trading so attractive. Unlike most careers, trading has no boundaries. No one to answer to, no fixed schedule, no earning cap. You can jump in with just a computer, internet connection, and trading account. But with this freedom comes hidden danger. Because there are no clear rules and no structure enforced by someone else, the trader becomes fully responsible, not just for decisions, but for consequences. Douglas draws attention to a key issue. Trading gives the illusion of unlimited possibilities, but most people aren't mentally prepared to handle that responsibility. The market doesn't care about your background, how hard you work, or how much money you need. It only responds to your actions. Without structure, discipline, and clearly defined rules, the very thing that attracted you to trading, freedom, becomes what destroys your chances of success. Many traders enter the market with the wrong mindset. They see trading as easy money. They believe that with the right system or a few good trades, they can get rich quickly. This creates dangerous expectations. And when trades go wrong, as they inevitably do, those expectations turn into disappointment, fear, or desperation. Douglas emphasizes that consistent success in trading is not about finding a secret method. It's about managing yourself, your emotions, impulses, and reactions to trade outcomes. Without structure and discipline, even the best trading strategy won't save you. One of the biggest problems Douglas highlights is the unwillingness to create rules. Traders want to stay free. They resist rules because they think rules will limit them. But in reality, rules are the only thing that create freedom in trading. Rules protect you from emotional decisions and help you act consistently. He's clear, without rules, trading becomes gambling. You might win sometimes, but you'll never have control. And without control, there's no consistency. Douglas urges traders to rethink what trading really demands. It's not just about knowledge or skill. It's about structure, mental discipline, and respecting the process, because the market rewards those who are prepared, not those who are just hopeful. The third chapter focuses on taking responsibility, and this is a turning point in the book. Douglas lays out one of the most important truths every trader needs to accept. You are responsible for everything that happens in your trading. It sounds simple, but it's not easy. Most traders don't realize how often they shift responsibility, whether it's blaming the market, a bad tip, news events, or their broker. But Douglas is firm. Until you take full responsibility for every trade and every outcome, you'll never gain the mindset needed for consistent success. Trading is unique. It doesn't come with structure. There are no managers, supervisors, or rules unless you create them yourself. You're the one clicking the mouse, deciding when to enter, when to exit, how much to risk, and how to react when things don't go your way. Here's the core issue. Many people come into trading trying to avoid responsibility, not embrace it. They want the money, excitement, and lifestyle, but they don't want to feel the pain of being wrong. They want the market to behave as they expect, and when it doesn't, they feel betrayed. Douglas says this mindset is dangerous because if you're blaming something outside yourself, you're giving up control. You're saying, "I can't win unless the market helps me." That belief keeps you stuck, reacting emotionally, avoiding losses, and constantly looking for someone else to blame. Instead, he urges you to take back your power. He says, if you've lost money, it's not because the market was against you. It's because of how you chose to engage with the market. That's a hard truth, but it's incredibly freeing. Once you take full responsibility, you gain control. You stop reacting and start responding. You learn. You grow. Douglas emphasizes that trading isn't about being right. It's about making decisions with clarity, managing risk, and accepting outcomes without guilt, fear, or blame. When you take responsibility, mistakes become lessons, not emotional scars. In the fourth chapter, Douglas introduces consistency as a state of mind. Douglas introduces a powerful idea. Consistency in trading isn't about your strategy, it's about your state of mind. Most traders think consistency comes from having a perfect system that wins most of the time. But Douglas turns that idea upside down. He says even the best strategies will fail if your mindset isn't right. Why? Because trading isn't just about logic or rules. It's about how you think and feel when facing uncertainty. The market is unpredictable. Every moment is unique. When you enter a trade, you don't know exactly what will happen. That uncertainty throws most traders off. It stirs up fear, doubt, hope, greed, emotions that pull you away from your plan. Douglas says, Consistent winners have learned to think differently. They don't need to know what will happen next. They've trained their minds to be okay with uncertainty. They understand that any single trade is just one of many, and each trade has an edge, but not a guarantee. That's the key, thinking in probabilities. Let's say your setup has a 60% win rate. Over time, you'll win 6 out of 10 trades. But you don't know which 6 will win. So you treat every trade the same, regardless of how it feels. You follow your plan, manage your risk, and accept the outcome. That's a consistent mindset. Douglas points out something important. Most traders already have a system that works. What they don't have is the mental discipline to follow it without letting emotions take over. They hesitate, jump in too early, second, guess themselves. That inconsistency in behavior creates inconsistent results. How do you fix that? Shift your focus from outcome to execution. Stop obsessing over whether a trade will win or lose. Focus on doing the right thing every time, placing trades when your setup appears, taking losses when your stop is hit, taking profits when your target is reached. No hesitation, no overthinking. Douglas says this discipline doesn't come naturally. It takes practice. But once you adopt this mindset, something powerful happens. You start feeling calm. You stop chasing trades. You stop avoiding losses. You become consistent, not just in results, but in how you feel and act, trade after trade. Douglas gives us a simple truth. The real edge in trading is psychological. Consistency is not found in the market, it's built inside the trader. Once you realize that, you're no longer at the mercy of the market. You become steady, focused, and fully in control of yourself. That's where success begins. The 5th chapter dives deep into the dynamics of perception. Douglas explores how we see the market and how our personal experiences, beliefs, and emotions shape that perception. He starts with something most traders never consider. 2 traders can look at the exact same chart and market conditions and reach completely opposite conclusions. One might see a buying opportunity. The other might see a sell signal. Why? Douglas explains we don't perceive the market objectively. We see it through filters made up of everything we've experienced: wins, losses, fears, hopes, beliefs about success, and our self-image as traders. When new information appears on screen, it gets processed through these emotional and psychological lenses. For example, if you've had a big loss recently from a failed breakout, the next time you see a similar setup, you might hesitate, not because the trade isn't valid, but because your perception is distorted by fear. You're no longer seeing what's in front of you. You're reacting to what happened before. This is where trading becomes tricky. We believe we're making rational decisions, but more often we're emotionally interpreting data. Douglas calls this the mental environment we trade in. If it's filled with fear, doubt, or unprocessed losses, it clouds our judgment. He introduces an important idea. Beliefs define perception. What we believe about the market, ourselves, and what's possible creates our internal map of reality. If your belief system includes fear of losing or needing to be right, those beliefs will distort how you interpret each trade. Once your perception is off, your decisions become inconsistent. Douglas compares this to looking through tinted glasses. If the lenses are colored by fear or anger, everything you see in the market will be affected. You'll overreact to normal price movement, miss opportunities, exit early, or hold too long, not because your system is wrong, but because your perception is emotionally biased. What's the solution? Douglas says you need to train your mind to observe the market without judgment. That means separating the present moment from past experiences. Each market moment is unique. Just because something happened before doesn't mean it will happen again the same way. If you're stuck in fear or regret, you'll miss what's actually happening now. He encourages traders to develop self-awareness, recognize emotional triggers, and understand personal biases. Once you do that, you start seeing the market more clearly, not through your wounds or hopes, but as it really is. In the 6th chapter, Douglas gives us the market's perspective. Douglas gives us a powerful shift in thinking. He encourages traders to stop viewing the market from their own limited perspective and instead understand the market from its point of view. He starts by reminding us of something crucial. The market doesn't care about us. It's not personal. It doesn't know who we are, how much we need to make, or how many losses we've had. The market is neutral. It's simply a reflection of all participants, millions of traders worldwide expressing their beliefs, hopes, fears, and strategies through buying and selling. So, if the market is just collective human behavior output, what does that mean? We have to let go of the idea that the market is against us or unfair. Many traders fall into this trap. They blame the market when trades don't go their way. They feel tricked or targeted. But Douglas makes it clear that's just ego and emotion talking. The truth is, the market doesn't do anything to you. It just is, a stream of constantly changing information. He explains that the key to becoming consistently successful is aligning your thinking with the market's nature. That means accepting the market is always right, realizing price movement isn't personal, understanding every moment is a unique event. If you think the market should behave a certain way because of your analysis, you're setting yourself up for disappointment. The market doesn't owe you anything. It doesn't follow your rules. It follows collective participant behavior, which is often unpredictable, short-term. Douglas introduces mental flexibility. Instead of forcing the market into our expectations, we need to become fluid in our thinking. We need to let go of rigid beliefs and stay open to what the market is actually telling us right now. He gives an example. Imagine standing in a river with strong current. If you fight the water, you'll struggle. But if you go with the flow, you move smoothly. Trading is the same. Fighting the market by insisting on being right or needing specific outcomes creates tension, frustration, and mistakes. But flowing with the market, accepting what it gives and responding calmly, leads to clarity and consistency. Douglas reinforces this truth. You don't need to know what's going to happen next to make money. You only need to align your actions with probabilities and stay emotionally neutral regardless of results. The message is clear. If you want to succeed in trading, stop seeing the market from your emotional, ego-driven view and start seeing it for what it really is. Not an enemy, not a puzzle, just a mirror of collective human behavior. Once you stop fighting it, you begin to trade with it. That changes everything. The 7th chapter reveals the trader's edge through thinking in probabilities. Douglas introduces a critical mindset shift, thinking in probabilities. This concept challenges many traders because it goes against our natural tendency to seek certainty and control. But Douglas argues this shift is key to consistent trading success. He starts by explaining that every trade is part of a larger process and no single trade has a guaranteed outcome. Whether you win or lose on a given trade doesn't matter in isolation. What matters is how you manage trades over time. Douglas compares trading to flipping a coin. If you flip a coin 10 times, you know it won't land heads every time, but over many flips, heads will come up about half the time. Trading works the same way. You don't know if your next trade will win or lose, but if you follow your strategy and take enough trades, you'll see probabilities play out. The problem is most traders approach the market as if each trade is isolated with no connection to past or future. They place a trade and immediately hope for a win. When they lose, they're disappointed because they expected the trade to go a certain way. But that expectation is the enemy of rational thinking. Douglas urges traders to stop viewing each trade as do or die. Instead, approach every trade as just one of many, knowing some will win and others will lose. It's the overall outcome that counts. The key is risk management. By managing risk and ensuring winners are bigger than losers, you create a scenario where even if you lose more than you win, you can still make money. Over time, probability of success works in your favor. For instance, with a 60% win rate, you can expect to win 6 out of 10 trades. But the key is not focusing on individual trade outcomes. Focus on sticking to your strategy, managing risk, and accepting that losses are part of the process. Douglas emphasizes that successful traders think in probabilities and embrace uncertainty. They don't need to know what will happen next. They understand the market constantly changes, and the only thing they can control is how they respond. The edge in trading isn't found in predicting the future. It's found in managing risk and understanding probabilities. What does this mean for you? You have to let go of the need to be right on every trade. It's not about predicting the market's next move. It's about creating an edge by consistently following your process and accepting random outcomes. In doing so, you'll become more emotionally neutral and focused on the bigger picture. The 8th chapter focuses on working with beliefs. Douglas takes a deep dive into the role beliefs play in trading. The beliefs we hold about ourselves, the market, and trading directly impact our success or failure. These beliefs shape how we approach the market, interpret price movements, and react to losses and wins. Douglas begins by explaining that beliefs are filters. Every trader comes to the market with beliefs that act as filters through which we interpret everything we see. These beliefs can be conscious or unconscious, but they always influence our decisions. For example, a trader who believes the market is rigged against them may enter trades with hesitation, expecting failure, making them more likely to react negatively when things go wrong. Conversely, a trader who believes the market is simply probabilities will trade with confidence and clarity. How do beliefs affect trading? According to Douglas, beliefs shape perception. If you believe you're going to lose money, you'll likely interpret price action with negative bias. You might second-guess decisions, pull out of trades too early, or fail to take profits when you should. Conversely, a belief in abundance, that there are always market opportunities, can make you more open to taking calculated risks and sticking with your plan during tough times. One of the most important ideas is limiting beliefs. These are beliefs that hold you back. For example, a trader might believe they're not capable of success, or they might have deep fears about losing money, causing them to avoid taking trades altogether. These limiting beliefs are often rooted in past experiences, like big losses or failures, creating mental blocks that prevent optimal performance. Douglas emphasizes that to become consistently successful, you need to challenge and change limiting beliefs. But this isn't easy. Changing beliefs requires self-awareness, patience, and willingness to confront uncomfortable emotions. He suggests traders examine their beliefs, especially negative or limiting ones, and ask, is this belief really true? He also advises creating empowering beliefs. These support success, such as believing you can learn from every trade, that you're capable of disciplined decisions, and that losses are just part of the process. Empowering beliefs create positive mindsets that support growth and long-term success. Douglas highlights that trading is as much about psychology as strategy. If your beliefs about yourself or the market are negative or limiting, you'll continually find ways to self-sabotage. However, by changing beliefs, starting with small, manageable shifts, you can rewire your thinking and transform your trading results. In the 9th chapter, Douglas explores the nature of beliefs. Douglas digs deeper into the essence of beliefs, how they form, impact decision-making, and why they're such a powerful force in trading. This chapter is about understanding beliefs, how they shape reality and influence every action we take in the market. Douglas starts by explaining that beliefs are learned. From birth, we absorb information from our environment, family, friends, teachers, society. We build beliefs based on these influences. These beliefs shape how we view ourselves and the world. For traders, these beliefs can either empower or hold us back. The key takeaway is that beliefs are not facts. They're just interpretations we make about the world based on experiences. However, many traders treat beliefs like facts, which creates problems. For example, a trader who believes the market is unpredictable and always out to get me will likely react to price movement with fear, hesitation, and anxiety. But that belief isn't fact. It's just interpretation, often driven by past failures or fears. Douglas emphasizes that beliefs aren't necessarily right or wrong. They're just filters through which we see the world. The issue is, if we hold limiting beliefs such as, I'm not good enough, or I can never make consistent profits, we filter everything through these negative lenses. When we encounter market challenges, we tend to magnify them and see them as insurmountable obstacles rather than opportunities to learn and grow. Beliefs also tend to be self-reinforcing. Once we form a belief, we subconsciously seek evidence that supports it while ignoring contradictory evidence. This is confirmation bias. For instance, if a trader believes they're unlucky and the market always goes against them, they'll pay more attention to times the market moves against them and ignore favorable moves. Over time, this belief strengthens, creating a vicious cycle of self-doubt and frustration. Douglas discusses how beliefs form in reaction to emotional experiences. If a trader experiences significant loss, that emotional experience can create beliefs like, "I can't handle losing money." The next time the trader faces potential loss, they may panic, hesitate, or avoid trading entirely. This emotional reaction becomes learned belief, preventing calculated risk, taking in the future. The problem with limiting beliefs is they keep us stuck in the past. We stop seeing the market for what it is, a dynamic, ever-changing environment, and instead filter everything through outdated, fear-driven beliefs. This is why challenging and reframing beliefs is so important. Douglas urges traders to be aware of their operating beliefs and constantly question them. Ask yourself, are these beliefs helping or hindering me? If the belief is limiting, it's time to replace it with something more empowering. For instance, instead of believing, "I can't handle losses," a trader could reframe that to, "Losses are part of the process, and I can learn from them to improve." He also points out that beliefs about the market are equally crucial. A trader who believes the market is chaotic and random will approach trading with fear and uncertainty. But a trader who believes the market moves in patterns and has structure will approach it with confidence and control. The beliefs we hold about the market shape how we interpret price action and make decisions. We can change our perception of the market and, ultimately, our results as traders. The more we align beliefs with trading realities, the more we empower ourselves to make objective, confident decisions. The 10th chapter examines the impact of beliefs on trading. Douglas takes a closer look at how beliefs directly impact trading behavior. He focuses on the critical idea that beliefs shape market perception, which influences decisions and, ultimately, results. Douglas reiterates that beliefs are filters. Every belief we hold about the market, ourselves, and trading is a lens through which we interpret everything we see. These beliefs are often so ingrained we don't realize they're affecting our decisions. But they are. Trading is emotional, and emotions are deeply intertwined with beliefs. If we believe we're in control and can predict the market accurately, we may act confidently. But if we believe the market is random, unpredictable, or against us, our actions reflect that uncertainty, leading to hesitation, overreaction, or avoidance. One of the most significant impacts beliefs have on trading is influencing risk, taking behavior. A trader who believes losing is catastrophic might avoid taking risks altogether, resulting in missed opportunities and stagnation. Conversely, a trader who believes losses are simply part of the process may be more willing to take calculated risks, knowing occasional losses are part of the journey. Douglas talks about how many traders struggle with fear of loss. This fear often comes from deep-seated beliefs that losing is failure or means you're not good enough. But Douglas challenges this view, arguing losses are inevitable in trading. In fact, he suggests if you aren't experiencing losses, you're probably not trading properly because the market is unpredictable. The key isn't avoiding losses, but managing them properly. He explains that how we react to losses is often more important than the loss itself. If you hold a belief that loss equals failure, you'll react emotionally, clouding judgment. You might revenge trade, trying to quickly make back lost money, often leading to worse results. Or you might shut down completely, avoiding trades because you're afraid of the next loss. Douglas introduces the idea of beliefs around money. For many traders, money represents more than just exchange medium. It's tied to self, worth, success, or failure. If a trader believes losing money means I'm a failure, every loss feels personal and devastating. But if a trader believes money is just a tool for measuring success, then losses don't carry as much emotional weight. The trader can learn from the experience without getting bogged down by negative emotions. He emphasizes that the most successful traders treat the market as a neutral entity, one that doesn't care about their feelings or past losses. Traders who can detach self-worth from trading results tend to be more objective and better able to stick to trading plans. Douglas notes that beliefs around control can affect how traders react to market movements. A belief that I must control every aspect of my trading can lead to micromanaging trades, overtrading, and inability to accept market uncertainty. On the other hand, a belief that I can control my actions but not the outcome allows traders to accept market randomness while maintaining control over their decisions. When you align beliefs with trading reality, that losses are part of the process and success comes from discipline and risk management, you become free to make decisions based on probabilities, not fear or past failures. Finally, in the 11th chapter, Douglas teaches us about thinking like a trader. In this final chapter, Douglas shifts focus to the core of a trader's mindset, how successful traders think, and how you can adopt this mindset to improve your trading results. He emphasizes that trading is not just about having solid strategy or perfect timing. It's about adopting the right mental approach. To be consistently successful, you need to think like a trader. Douglas begins by explaining that one of the major challenges traders face is treating the market like a personal battle. They think of each trade as an isolated event and tie their emotions and self-worth to that single trade's outcome. But a true trader understands that trading is a process, not a series of individual wins and losses. A key concept is objectivity. Successful traders don't get emotionally attached to any single trade. They understand the market moves up and down, and no trade outcome is ever guaranteed. Rather than reacting emotionally to wins or losses, they remain calm, focused, and detached, always thinking in probabilities. Thinking like a trader means accepting that the future is uncertain and each trade outcome is unpredictable. Each trade is simply one opportunity within a larger process. The market moves up, down, and sideways, and every moment offers a new probability. Traders who think in probabilities are less likely to be shaken by inevitable ups and downs. They understand it's not about being right all the time, but about managing risk and executing strategy consistently over time. Mental discipline is crucial. Thinking like a trader means sticking to your plan regardless of market conditions. It's about controlling emotions, especially fear and greed, which are the most common trader pitfalls. Fear prevents you from entering trades or causes you to exit too early. Greed leads you to take unnecessary risks or hold trades too long, hoping for bigger profits. Successful traders recognize these emotions and have strategies to manage them. A key part of thinking like a trader is accepting losses as a natural part of the process. Douglas argues traders need to embrace losses, not fear them. If you have solid strategy and manage risk properly, then losses should not be sources of stress or self-doubt. They're simply part of the journey. In fact, if you aren't experiencing losses, you're probably not trading properly. The key is learning from them and improving rather than letting them shake confidence or cause you to deviate from your plan. Douglas talks about mental flexibility, being able to adjust thinking based on new information. Markets constantly change, and what worked yesterday might not work today. Successful traders need to be adaptable, open-minded, and willing to adjust strategy as needed. This doesn't mean chasing every new trend, but being flexible enough to recognize when the market is telling you something different and responding appropriately. Finally, he stresses that trading is about consistency, not perfection. Thinking like a trader means focusing on the long-term process, not short-term results. It's about executing strategy with discipline, managing risk, and letting probabilities play out over time. The more you practice thinking like a trader, the more natural it becomes, and the more successful you will be.